The banks don't believe that to be true. We are all expecting rates to hike sooner than that. Traditionally, I would say roughly, what do we think? 6, 7, 8 years, we've been in a declining rate market. Rates have been coming off. Great news. Everyone keeps being told to renegotiate their rates around home loans and all these other things. Now, the reality is rates are pretty much as low as they're ever going to go. This is where we're at. We saw an increase in rates for 25 basis points about 6 weeks ago. Now, the thing to remember with asset finance is they're fixed term, fixed contracts. So typical terms would be 3, 4, or 5 years. We don't write anything longer than 5 years. It's a poor outcome for the client typically. So what's happening is, whilst the RBA is releasing data claiming to not be looking to hike rates again until 2024, it has to be kept in mind that if you take out an asset finance deal now with a view that it will end in 5 years from now, taking you through to 2026, the rate will not be the same for the financier. So what they need to do is they need to factor in essentially what they feel rates are. And without going into a full explanation around money markets and how banks acquire money and rates and all these things. But typically there's a yield curve, what we call at the back end. So 5, 10, 15, 20-year rates and bonds where banks trade money to each other, essentially. The yield curve, as we would call it, went what we call bid. So it increased. And it increased in the back end in the 5, 10, 15-year space, purely because people know rates are going to increase. And it hiked prior to that period. So it started hiking in 2 and 3 year space. It hiked sooner than how do I explain it? So it went up sooner than what the RBA is claiming that rates will increase. So whilst the RBA is saying they think it will go up in 2024, the banks don't believe that to be true. We are all expecting rates to hike sooner than that. And the reason behind that is, forget about increasing house pricing. Let's leave that to one side. But we're talking about a rapid decrease in unemployment. We're seeing it accelerating faster than we expected. We're seeing GDP shoot up faster than expected. And the economy is looking in much better shape than what we first thought. I mean, obviously tourism, retail, and hospitality are industries that are still struggling. They're still rebounding. But if we look at construction, infrastructure spending, and all these other areas, that is rebounding rapidly. And that in turn is creating positive market sentiment, which in turn is driving an increase in interest rates. So we expect the market to rebound faster, which in turn will dictate to the RBA it is now time to start increasing the cost of funds, which in turn will have an impact on your loan.